That is relevant costing and short-term decision-making or special decision-making. Now we spoke about what relevant costs are. We spoke about opportunity costs. We spoke about sunk costs and those costs that are in the future that do not differ between alternatives. So that makes them unavoidable, right? So we have avoidable and unavoidable costs, and avoidable costs are the only ones that are relevant. We also spoke about the fact that relevant costs only have to be, there has to be a flow of cash. They have to be costs that are in the future. And what's the third one? Who remembers the third one?
May I try?
Yeah, please.
Must be directly linked to the decision in question, the decision to be made.
Yes, that's true. There has to be a correlation between the decision being made and that cost that we are talking about for that cost to be relevant. Right, so then that makes, if there has to be a flow of cash, then that makes depreciation is never a relevant cost, because depreciation is not a flow of actual money, but it's a notional cost. So which means it's an allocation or reallocation of the purchase price of a specific asset. We also spoke about how to calculate the relevant cost of when it comes to materials, when it comes to labor, and when it comes to overheads. So materials, both of these have some specific guidance on them, especially on materials. You really need to get to, there's a diagram. I think once you get the diagram, I think you get materials like that. The moment you understand the diagram or the summary of materials, then I think you will get the materials, or you can be able to deal with the questions on materials better. Okay, so today we are finishing this slide, and then we can start with some new slides on, or the second slide on relevant costing. So this one, what we are starting with today, we are starting with an example. So we are trying to identify relevant costs. So we have an example here. Let me try to make these letters bigger. It's too big. Okay. So Cynthia is a student in Boston, and she is considering visiting her friend in New York for 2 days. Now she can drive or take the train. She has those two options, drive or take the train. If she drives, she will drive 230 miles to her friend's apartment. Now she's trying to decide which alternative is less expensive, and she has gathered the following information. So the first line, that one that's in yellow, right? It's telling you that below that line is the annual vehicle cost, how much it usually costs per for the vehicle, and this is based on a total of 10 miles that she usually drives every year. So the annual straight line depreciation on the car is 28,000. So it depreciates it loses 28,000 every year. And the cost per mile, that is 28,000 divided by the 10,000 miles per year. That gives you $0.28 dollars per mile. Now the cost of gasoline, how much it costs for her, this would be petrol in Namibia, is 0.050, that is per mile. Annual cost of auto insurance and license would be 1,320, 380 actually, and per mile, this is the conversion of the per mile version, and this is the total, right? So maintenance and repairs, every mile she has to maintain her car, and it costs her 0.065. Now this is in US dollars, so the 0.0, the cents, it's not really that weird, because the US dollar is high, especially when you compare to Namibian dollars. Parking fees at school, because she's a student, it cost her $360 per year, and her total average cost per mile is 0.569. This is how much it cost her to operate her car every year. Okay, so that is per mile though. So you have some additional information here that number 7, reduction in resale value of the car per mile of wear. So every time you drive your car, the resale value reduces by 0.026 every mile. Now, it costs $104 for the round trip train fare. So to go and come back by train, it costs $104. Now, she also has benefits of relaxing on the train trip. Now, this one has question marks. The reason is because it cannot be quantified. You remember the qualitative factors that you should consider whenever you are dealing with relevant cost questions? This is one of them. So the benefits of relaxing on a train, that it cannot be quantified, but it's a benefit, so she has to consider that as well. Number 10, cost of putting dog in a kennel while gone. So she has a dog and she has to put it in a kennel. It's like a babysitter for dogs, I guess. And she has to put it in a kennel while she's gone so they can take care of her dog. Benefits of having the car in New York. That one is also not quantifiable. That's why it has question marks. And then you have number 12, hassle of parking the car in New York. If she goes with a car, it's going to be a struggle parking the car in New York because of traffic and so forth, I guess. And so that means that's also not quantifiable because it's not a dollar amount. It's just, it's a qualitative factor, right? So the last one, how much it costs to park in New York is $25. So we are trying to determine or to identify the relevant costs. So based on this, which of the costs here look irrelevant? Just off the bat, which ones of these costs look like they don't matter in this decision? Can I get a take up, please?
Annual straight line depreciation on car.
Annual? This one, or depreciation on car, okay. So annual straight line depreciation, why? Why is the depreciation one not relevant?
Because it doesn't cause an outflow of cash.
Yes, that's correct. So what else? What else is irrelevant? What about putting the dog in a kennel? Is that relevant or irrelevant? Amana, you want to say something? Okay. So then let's consider which costs and benefits are relevant in Cynthia's decision then. So the cost of the car is a sunk cost and is not relevant to the current decision. So the cost, how much it costs the car is not relevant. That's why depreciation is also not relevant, because it's a notional cost and it's based on a sunk cost, because it's based on how much it cost the car cost, which is an irrelevant amount. The annual cost of insurance is not relevant. It will remain the same if she drives or takes the train, because you pay your insurance every year. That means how much it costs you to pay, how much you pay for your insurance every year, that one does not matter in this decision. Whether you go to New York by train or you drive, you will still pay your insurance. Now, the cost of gasoline is clearly relevant if she decides to drive, because if she takes the drive, the cost will now be incurred. So it varies depending on the decision. If she chose to go by train, then she would not incur the petrol cost or gasoline cost. That's why it will be relevant for this decision. Now, the cost of maintenance and repairs is also relevant, because in the long run, this cost will depend on the miles that you drive. So the number of miles that you drive will determine when to take your car for maintenance, because at the end of the day, your car will need maintenance as you use it, right? So if she drives, then her maintenance and repairs cost will be incurred or will go up, or the likelihood of them will go up, or she will need to take the car for maintenance because of the miles driven. That's why that's a relevant cost. The monthly school parking fee is not relevant because it must be paid if Cynthia drives or takes the train, because you pay for parking every month. So whether you go by train or not, you're only going for 2 days. So it's not like you're gonna go for 2 months. So you can say that I'm going to put a halt on these parking fees. She's going for 2 days. So the parking fees are not affected, either decision she decides to go with. So they are not relevant. And it also says that at this point, we can see that some of the average cost of 0.569 per mile are relevant, while others are not. So we have to take out the ones that are relevant, and we have to ignore the ones that are not relevant. Now, the decline in the resale value due to additional miles is a relevant cost, because if you drive, then your resale value will decrease. So that's a relevant cost. The round-trip train fare is clearly relevant. If she drives, the cost can be avoided. So it's an avoidable cost, because if you decide to drive and not take the train, then you can avoid that train fare. Relaxing on the train is relevant, even though it is difficult to assign a dollar value to the benefit. So if you decide to drive, you will forego that benefit of relaxing on the train, because you can, if you take the train, you can read your book, you can sleep. But if you are driving, you cannot do those things. And that is something that you can forego if you drive, but you cannot put a dollar amount on it. However, it is a relevant cost. The kennel cost is not relevant, because this Cynthia will incur the cost if she drives or takes the train. This is the dog kennel. Because you are going to go to New York anyways, the decision is not go to New York or not. It's should I drive or should I take the train? So either way, you are going to leave that dog in a kennel, if whether you decide to drive or take the train. So it's an irrelevant decision, or it's an irrelevant cost.
Ma'am?
Yeah.
I have a question.
Mm-hmm.
Okay, let's say we own a business, and then the business, what we do is, okay, we own a fuel station. And now when you recorded the fuel station in your books, you capitalize the dismantling cost to the cost price of the asset itself.
Yeah.
How would you classify dismantling costs? Because don't you end up paying for it in the future, but then it's capitalized to cost, which means the cost of the asset is a sunk cost.
Is it affected by the decision in any way?
Or let's say we are getting rid of the fuel station in one of our branches here.
Okay, so the decision is what's the decision? What is the other?
To dismantle, because it's maybe not making a profit in the branch that it is in.
Okay, so it's the decision is keep or dismantle.
Yes.
Okay, so at the end, initially, when were the dismantling costs going to be incurred?
Excuse me, ma'am?
Yeah, because you are saying the dismantling costs are included in the cost of the service station, right?
Mm-hmm.
Now, when were those costs going to be incurred? Because either way, they are going to be there, whether you dismantle it now or dismantle it in the future. So I think that now the opportunity cost in that case would be the time value of money. How much it's going to cost you if you did it later than now, I guess, because whether you keep it, you are still going to incur it, right?
Mm-hmm.
Does that make sense?
Yes, ma'am.
So then I think in that case, it just becomes a discount. The discounting cost of discounting would be the relevant cost, which I don't even think you would be given that. But if it's given in the question, you would probably be given some discount values in there to say, if we dismantle it today, the company will save this much, but if they dismantle it in 30 years, which was the initial plan, then this is what's going to happen. So then the relevant cost would be in that. But either way, whether you dismantle today or in 30 years, you are still going to include that cost. Does that make sense?
Yes, ma'am. Okay, thank you, ma'am.
Okay. Okay, so the cost of parking is relevant because it can be avoided if she takes the train. So if she decides to take the train and not go with the car, then in New York, she won't have a car to park, so she can avoid that cost. That's why it's relevant. The benefits of having a car in New York and the problems of finding a parking space are both relevant, but are both difficult to assign a dollar value to. So they are relevant costs. However, you cannot put money on it. So it's not quantifiable. So based on those things that those points that we just went through, this is the quantitative numbers or the quantitative considerations of the relevant cost for this decision. So if she takes the car, if she drives, then it's going to cost her 460 miles. Now that is a total miles of going and coming back, because the question says it's 230 it's 230 miles to her friend's apartment. That means going and coming back would be 230 multiplied by 2, so it's 460. So 460 in total miles multiplied by 0.050. That is the dollar per mile in gasoline. So that will be $23. And for maintenance, it's 460, the total miles she's driving, multiplied by the cost per mile. That gives you 29.90. And the reduction in resale value, it says that for every mile that you drive, you reduce the resale value by 0.026. So you multiply that by 460 miles that you're going to drive, and the resale value will reduce by 11.96. Now, parking in New York, the question says that parking is $25 per day, and she's going for 2 days. That means she will incur $50 in parking fees. So if you add all those together, that will give you 114.86. That is how much it will cost you to drive. That is the relevant cost of driving to New York. Now, when you compare that to the round trip ticket for the train, which is at 104, that means that you will be saving $10 if you took the train than if you have driven. So based on that, we are recommending that Cynthia would be better off to take the train than to drive. Now, some of the non-financial factors may influence her final decision. Now, if you were Cynthia, then you would take these quantitative factors, which are the financial factors, and then compare those to the non-financial factors to say, okay, it's going to be cheaper if I take the train, but then I really want to have a car, or I want to be flexible in New York. If that is important to you, if you were Cynthia, then you would make a decision based on the quantitative factors as well. But we are recommending, based on the financial factors, that she takes the car instead of the train. The train instead of the car. Does that make sense?
Yes, ma'am.
Okay. So this line below here just says that the cash flow that differ between alternatives are called incremental or differential cash flows. Those that are different between the two alternatives are called differential cash flows or incremental cash flows, okay? So that's just for you to know. You could find a question that's telling you that has this word. You need to know that when we are talking about differential cash flows or incremental cash flow, then we are talking about the cash flow that differs between the two alternatives. Okay, so the second example is for a company that is considering changing their marketing method from direct marketing to internet marketing. Now, internet marketing has become increasingly popular since it allows the business to reach their target audiences online, which increases sales and decreases their advertising cost. Information relating to the two marketing methods is provided in the table. So you have this table. One column tells you that this is the cost and the income that relates to direct marketing. This one in the second column of the last one is the one that relates to internet marketing. So this basically is an income statement, right? So you have your revenue less cost of sales minus your expenses. That gives you your net income, right? So this question is asking, should the company change their marketing method, or should we change the marketing method from internet marketing to direct marketing? Now I went ahead and highlighted in red the things that the cost and benefits that are relevant, which means they changed between the decisions. As you can see, revenue, when we changed from direct marketing to internet marketing, the revenue changed. So on internet marketing, revenue is 2.5 million now, and it was 1.5 million when it was, it is currently at 1.5 million. If we change to internet marketing, we are projecting it to increase to 2.5 million. The cost of sales will also increase from 750 to 250 million. So that means that it's a relevant cost because it is changing between alternatives. Commission will be totally wiped out. If we change to internet marketing, we will not need to pay commission. Advertising costs, then that will be reduced from 75,000 to 38,000. So it's also a relevant cost because it is changing between alternatives. Warehouse depreciation does not change whichever decision we decide to take, and so does other expenses. So do other expenses. Those ones also don't change between the alternatives. That's why I did not highlight them, because they are not relevant to these decisions. Okay? So now, based on those income statements, would you recommend the company to change their marketing methods? Guys, should the company change to internet marketing?
Ma'am, I'd say they should change.
Why?
Um, there will be more revenue, which will, I think, result in more profit, and the expenses also lower. So,
Yeah, that's correct, actually. So we will make more money. Just look at the net income. It's rising from 490 to 1.1 million. So if we changed to internet marketing, we would make more revenue and would make more profit. So the recommendation should be the company should change their marketing methods. Okay, so do you have any questions? Okay, so if you don't have any questions, we are going to start with the second slides on relevant costing. So the previous slides, we basically just covered introduction to relevant costing. So we defined what it is, what types of relevant costing are, and how to identify the relevant cost in a specific decision, right? So now, or in a certain decision, now we are getting more specific. So we are going to talk about the different decisions that we can